Welcome to Policy Pulse by Rauf, where we break down global regulatory shifts that shape the financial world. This week, two of America's most powerful regulators, the SEC and the New York Department of Financial Services, issued major new guidance on crypto custody and blockchain analytics. Their message is clear: the future of digital assets depends on compliance, custody, and clarity. On September 30, 2025, the NYDFS updated its rules for financial institutions holding customer crypto assets. The goal: protect consumers and ensure transparency in how virtual currency is stored and safeguarded. First, segregation of customer assets. Firms must clearly separate client holdings from their own, with precise records to track every digital coin. Second, no use of client assets for corporate purposes. Custodians can't borrow, stake, or pledge customer crypto. It belongs solely to the client. Third, sub-custody oversight. Firms can use sub-custodians only after full due diligence and prior NYDFS approval, and those sub-custodians must meet equal or stricter regulatory standards. Fourth, mandatory disclosure. Clients must receive clear written terms, no hidden clauses, no fine print. In short, NYDFS is tightening the screws, demanding accountability in how digital assets are held, and who holds them. The same day, the SEC's Division of Investment Management issued a no-action letter that could reshape digital asset custody nationwide. The SEC now recognizes that state trust companies can qualify as qualified custodians for investment funds, provided they meet strict conditions. To qualify, trust companies must be authorized to provide digital asset custody, maintain audited cybersecurity and internal control frameworks, and sign written agreements ensuring full compliance with SEC standards. Registered advisors and funds using these trust companies must disclose associated risks and verify that this setup best serves client interests. This is a landmark clarification, bridging the gap between traditional banking oversight and digital asset custody. Just weeks earlier, on September 17, 2025, the NYDFS issued another major update, this time on blockchain analytics tools for banking institutions. These tools allow banks to trace transactions, identify risky wallets, and detect suspicious blockchain activity tied to sanctions or financial crime. NYDFS now urges all regulated institutions to integrate blockchain analytics into their AML and CFT programs. They're expected to screen customer wallets and verify fund origins, assess counterparties and third-party risks, compare expected versus actual crypto activity, and use real-time data to refine risk appetite. In short, blockchain analytics are no longer optional, they're now a compliance necessity. Together, these actions by the SEC and NYDFS represent a clear regulatory direction, not to restrict innovation, but to regulate it responsibly. Financial institutions are being asked to adapt, adopt, and align with the standards shaping tomorrow's digital markets. Those who view regulation as a strategic asset, not an obstacle, will be the ones who lead in the next era of finance. You've been watching Policy Pulse by Rauf, with where we keep you ahead of the rules that move markets. How do you see these changes impacting banks and fintechs? Will regulatory clarity accelerate innovation or slow it down? Share your thoughts in the comments.